Topic 1. Iran war and geopolitical risk driving oil shock. The month-long U.S.-Iran conflict has effectively choked the Strait of Hormuz and seen Iranian attacks on tankers and nearby targets, including a struck Kuwaiti tanker, causing severe disruptions to seaborne crude transport and violently roiling oil-linked markets. Brent surged roughly 59% in March, the largest monthly rise on record. WTI rose about 58%, with short-term prices in the triple digits, Brent around 113.20, WTI over 100, and first quarter gains of roughly 86% for Brent and 79% for WTI. U.S. pump prices topped $4 per gallon, about $4.02, raising consumer burdens and political fallout. Rerouting around Suez and Bab el-Mandeb is underway, but exposes crude to other regional risks and choke points. The energy shock is amplifying inflation and market volatility, boosting dollar strength and pressuring gold. While governments try measures, SPR releases, relaxed fuel blend rules, but warn that full recovery of transport routes and infrastructure will take time and that prolonged disruption could push prices much higher. Topic 2. Market volatility and investor positioning. The Middle East conflict and oil supply fears drove Brent toward the mid-$110 and WTI to about $104, sparking sharp volatility across equities, bonds, and currencies, and pushing many investors into defensive postures while also prompting some buy-the-dip calls. Demand for safe assets raised treasury buying, nudging the 10-year yield down to about 4.328%, 2-year 3.803%, 30-year 4.99%, a sign markets are repricing near-term growth and interest rate expectations and contributing to views that the Fed may not need an immediate further hike. Chair Powell signaled inflation expectations are stable and implied no urgent rate move. At the same time, indicators of tighter financial conditions suggest significant tightening already occurred, which could constrain Fed options going forward. Equities reflect the split view. The S&P 500 is approaching correction territory, near 10% off highs, while the Nasdaq has already entered correction, illustrating simultaneous fear-driven selling and opportunistic quality buying. Topic 3. Labor market softening. U.S. hiring has slowed to the weakest pace since 2011 outside the pandemic, with February hire rate at 3.1%, the lowest since April 2020, excluding the pandemic. Total hires at about 4.85 million, the lowest since April 2020, and job openings sliding toward roughly 6.9 million from about 7.2 million. February quits fell to around 2.97 million, near post-2020 lows, signaling weaker worker confidence and reduced labor churn, while youth have been hit hard. 20 to 24-year-old unemployment spiked to as high as 9.2%, and internship postings fell over 15% between 2023 to 2025. Employers are largely freezing hiring without widespread layoffs, creating a low-hire, low-fire pattern that, combined with high rates, geopolitical uncertainty, AI adoption, and rising fuel costs, is cooling labor demand. The slowdown risks lowering consumption and delaying recovery, with long-term scarring for career entry unless policy and corporate responses address the gap. Topic 4. Corporate deal-making and restructuring. McCormick agreed to acquire Unilever's food arm, brands like Hellmann's and Knorr, in a deal valued around $45 billion, paying about $15.7 billion in cash, and arranging a share exchange that would leave Unilever shareholders with roughly 55 to 65%, and McCormick shareholders about 35% of the combined company. The merged group would target roughly $20 billion in annual revenue, modest cost synergies, estimates $300 to $600 million, and a 2027 close pending approvals, while initial market reaction saw McCormick down 6% and Unilever down 4%. Opendoor is buying parts of Doma, title, escrow, closing assets, and about 85 employees to combine Doma's ML-driven title risk tools with Opendoor's closing capabilities and reduce closing time and cost, including pilot work with Fannie Mae. Big pharma moves include Eli Lilly's takeover of Centessa for up to $7.8 billion, about 6,